Real estate is all about location. A global investor explains where they're looking to purchase. Plus, uncertainty has European investors keeping their cash on the sidelines. We'll explore why. This is 7-Day Yield.
Welcome to 7-Day Yield. I'm Mitch Rochelle.
And I'm Lydia Moorish, and here's what's trending. For nearly a decade, U.S. GDP has grown at a sluggish rate measurably below historical trends. As policymakers and politicians alike employ a host of tools to stimulate growth, one of the keys to economic growth may be found in demographics. The recently released PwC Young Workers Index reveals that opportunities exist for GDP growth through the reduction of unemployment among young workers. The key will be for firms to focus on inclusion by coming up with targeted solutions aimed at different demographic groups rather than taking a one-size-fits-all approach.
The digital age will unlock enormous potential for business growth over the next 5 years and beyond. However, global CEOs express concern over the risks brought on by technology. According to the recently published PwC CEO survey, business leaders' concerns include data breaches, IT outages, and social media usage risks. Specifically, CEOs see these areas as potentially impacting business continuity and eroding shareholder trust.
It seems inevitable that organizations are becoming increasingly more digital over time. And while this may be a good thing for customers, a sizable number of CEOs are firmly convinced that it's harder for businesses to gain and retain people's trust. In fact, 58% of CEOs are concerned that a lack of trust in business would harm their company's growth. But with every risk comes an opportunity, and 64% of CEOs believe that their firm manages data will be a differentiating factor in the future. Well, as we look ahead into 2017, we learned that it's not just a question about where to invest when it comes to the global real estate market. Mitch recently sat down with the Chief Financial Officer of Ivanhoe Cambridge, Nathalie Palladitcheff, who walked us through the key fundamentals of how they plan to invest money in the real estate market. Take a listen.
Give me a perspective, so where you sit, you look at the real estate asset class globally. So maybe you could break down the real estate world from a continent perspective.
As a long-term investor, I think that probably the key driver of our investment strategy is demography. So we are looking around where the people are going to live tomorrow, are going to work, where they are going to buy things. So it leads us to, I think, three main angles for the future. Logistics and the way it's related to retail. Of course, emerging countries and the way those cities are going to be equipped tomorrow. And residential. And I think that those three fundamentals are going to be probably key in the future in the way we're going to invest our money.
So as the world gets older demographically, and as the world shifts towards urban centers, are those playing a big part in your long-term strategy?
Yes, definitely we see that there are some discrepancies between those two generations in the way they want to live the cities and the world. So that's major, I think, in the way we're going to choose the locations.
What's interesting, when you talked about retail, you immediately said logistical, which in my mind thinks about sort of last mile delivery. Is that a global challenge as much as it's a US challenge for us, that dealing with that last mile for online shopping?
I would say that maybe the most interesting country regarding that for the time being would be China, more than US. The amounts are so huge and the people are so different in the way they are buying today compared to the US. So that's why, as we used to be one of the best retailers, investor, we think that logistic is logically the thing that we have to be interested in the future.
Predictive analytics plays a big role in online retail. I would think with the size of the population in China, they'd have even better data and know what people want where. Is the predictive analytic piece a big component of the whole logistical real estate play? So it's not just the hard asset, it's also the soft asset in all that knowledge, right?
Exactly. And that's why we are looking for the best partner and to really implement these partnerships, help us to understand the needs of the population, where we want to invest our money. In a world where the competition is going to be very tough, we think that those partners are going to be the key. And we have a very good one in China especially.
To continue the discussion regarding global real estate, we are once again joined by Byron Carlock. Welcome, Byron.
Thank you.
So Natalie talked about where they want to invest, but if we take a step back and look at why rising interest rates probably won't scare people from investing in real estate right now.
I think the biggest thing to look at first is allocations by asset managers for the real estate and real assets sector continue to go up, so there's more capital to invest. Some of that is interest rate insensitive, and frankly, the expectation is rates are not going to rise that dramatically. So I think that the boundaries for the interest rate rise will not curtail capital flows into real estate, especially U.S. real estate.
Even though they're projecting possibly four more interest rate rises over the year?
4 more rises at 25 bips each is not enough to stall the continued real estate recovery.
Is that a global phenomenon? Obviously, we're going into a better economic story than the rest of the world, so we're raising rates while other countries are still in maybe negative interest rate zone. But is the phenomena of more tailwind than headwind really a global phenomenon?
There are 2 components to that, in my opinion. Number one is the negative interest rate countries have asset managers that are working diligently to move money into environments where yields are positive. So that's one big one, and the Japanese investors are probably the most profound example of that. The second is back to the allocation percentage to real assets. There's a real romance right now with hard assets because the perception is rates are still too low in the bond environment, and there is fear that the equity environment may be at a peak. And so hard assets are the investment du jour.
I think about REITs. REITs have got banged up pretty badly in 2016, largely because they were viewed, I guess, as fixed income alternatives. Since the fundamentals are good, if I'm hearing you correctly, do REITs sort of bounce back? And as, again, thinking about the United States and thinking about real estate as a retail asset class globally.
One would hope. It's interesting and I think, frankly, ironic that every time interest rate increases are discussed, the whole REIT sector takes a beating. I frankly believe there are many REITs that are undervalued right now and in fact deserve more allocation than they're getting. What's happening instead is the capital markets are using this as an opportunity to aggregate M&A opportunities in the REIT sector, and then you see private equity firms actually taking public REITs private.
So that's going to be a trend for 17 that we should look out for.
I think that's a trend for 17.
Byron, you earned your way onto the rest of the show, so
thank you, Mitch.
That's a good thing.
After the break, we have more in global investing. Stay with us.
The new administration has brought into focus offshore cash. I recently spoke with Steve Libby, PwC Asset and Wealth Management Leader in Luxembourg, to better understand cash in Europe. Take a listen. Steve, you mentioned that there's a tremendous amount of cash sitting on the sidelines in Europe. Maybe you could put that into perspective and characterize why.
If you look at what's happening, you've got low interest rate environment, you've got market volatility, and you've got all this political uncertainty. So it's a really tough market, and basically there's a lot of cash with all that uncertainty that's just sitting on the sidelines, waiting to see, what could be a better choice.
Is that just uninvested assets in the asset and wealth management space, or are they just outside of that world altogether?
It's really just a lot of cash in banks. So bank accounts that aren't earning, as you know, in Europe, we even have negative interest rates. So, crazy. And so it's just sitting there, and it's
I'm going to pay you money to keep an eye on my cash.
Exactly. Yeah. And some people just feel that that's a good place to be because of all this uncertainty that's going on.
When I think about the United States, we've taken the asset and wealth management business to the banks, and the banks are in fact in that business. Is that the same profile that exists in Europe?
Yeah, for sure. I mean, the banks still dominate. They're the biggest distribution channels. I would say in the asset management, the asset managers, in terms of where they're coming and bringing solutions, that they're still struggling. So, it's really the banks, through their investments, institutional accounts, that then it gets to the end investor.
When cash creeps out of the bank and into the invested world, where's the leading edge of that cash going?
Still in mutual funds, but also, into mandates as well. So there's not that much cash being deployed into, traditionally like in the U.S. With other mechanisms like 401k and so forth.
Well, you mentioned low interest rates, if negative interest rates, which suggests, and we've seen this in the States and some other theaters around the world, that there's been a chase for yield, and that chase for yield gets people off the sidelines and into something, maybe in the alternative space. Is that a trend that's emerging as well in Europe?
Yeah, for sure. We have some serious issues that we're trying to deal with in Europe. One of them is this looming pension bomb, as we call it. So it's basically public pensions. That money needs to be invested in a medium to long term. So if you look at that horizon, it's really the alts and real investment, real assets, in private debt, in infrastructure. That's where money needs to go to respond to those needs.
Do you have the same issue that we have here, which is those pension funds had a yield expectation and they just can't get that yield, so they're going up the risk curve and going into alternative investments and real estate? And then I guess if that is in fact the case, are those asset classes really as risky as people think they are?
They're probably misunderstood in terms of the way that the risk profiles. In terms of the investment into those asset classes, clearly we see greater allocation towards especially real estate, but you see appetite as well for private debt. So it's really investing to fuel the real economy. And we have the CMU, which is one of the levers that the European Union is trying to use to facilitate that.
One of the things that I'll sort of close with, when a lot of Americans think of Luxembourg, they think of it as a haven of sorts for regulatory and perhaps even tax advantages. And in light of some policy changes that may be coming out of the States, is that likely going to disrupt the landscape in Luxembourg or not at all?
In terms of the asset management industry, Luxembourg is all about cross-border distribution. So it's basically helping to distribute products throughout the world, I would say US. In terms of tax and so forth, it's really not the reason that this industry in Luxembourg developed. It's really serving those needs of investors worldwide and using Luxembourg as a platform to help to do that.
So the platform will still be there, notwithstanding policy changes in the States?
Well, I think so. There's going to be a lot of challenges. So there's things coming in with technology, blockchain, and so forth that may disrupt the way that those channels work. But in terms of the actual need of the end investors, it's a great platform to actually reach out to those investors and provide solutions.
Byron, welcome back.
Thanks, Lydia.
So Stephen mentioned in the interview that Europe is seeing low interest rates, market volatility, and a lot of political uncertainty. And because of that, there's a lot of cash, just what he said, sitting on the sidelines. The US is kind of in a similar situation. So are we also sitting a lot of cash just sitting on the sidelines here in the US?
There is a lot of cash sitting on the sidelines waiting to be invested. It's been exacerbated in Europe because of Brexit. And there's the expectation that there will be follow-on issues associated with investment environment like Brexit in other countries. And so the U.S. is actually the beneficiary of capital flows as a result. So we've got cash sitting on the sidelines in our own economy, but primarily because of increased allocations to hard assets, plus capital in foreign investors' pockets that might have otherwise been allocated to opportunities in Europe, specifically London, that are now coming our way.
Byron, when I think about sort of the global perception of the United States, because one of the things that I'm fascinated with is that you have more frequent flyer miles than I do. It's an absolute obsession of mine.
Yes.
But as you travel the globe solely to have more miles than me, what's the perception about the United States right now in the eyes of foreign investors?
So right now, actually, we are the favored nation for investment right now. I believe
all asset classes?
Almost all asset classes. Certainly office, industrial, multifamily. I think everyone's trying to see what's going to happen on retail. So on the industrial side, it's actually the beneficiary of people were previously allocating to retail because of the logistics component associated with e-commerce. But almost all asset classes and a growing number of cities, whereas post-global financial crisis, most of the investment focus was just on the 6 coastal gateway cities. You've seen an interest in many of the 18-hour cities that we've identified. Cities like Portland, Nashville, Indianapolis, Louisville, Dallas, Salt Lake City, Seattle have all seen inflows of capital coming with interest in real estate.
And when those investors bring that sideline capital that's in Europe into the United States, are they looking beyond real estate as well, maybe infrastructure, maybe even stocks and bonds?
So I think so. I don't know so much about bonds, and I think many people are wondering how toppy the stock market is. I do see this real assets category benefiting when there are investments available. I think in 2017, we'll see a lot of interest in infrastructure and infrastructure-related investments. Infrastructure funds were big fundraisers in 16, so hopefully that money will start being deployed in 17. And I also think that we will see some M&A activity in the public markets that inspire additional investment dollars into the space.
And lastly and quickly on infrastructure, obviously the new administration's focused heavily in terms of infrastructure investment. Do you see a public-private partnership as being a model that gets used in terms of how infrastructure dollars get deployed?
Absolutely. It's going to require some legislative improvements at the state and local levels because many legislative jurisdictions have not set up themselves to do public-private partnerships, but it's clearly an intent of the new administration to inspire infrastructure investment in a public-private partnership format.
Great stuff, Byron. Thank you. We're going to have you back real soon.
Thank you, Mitch.
Well, so speaking of the new administration, on our next episode, we'll be talking about the financial institutions and the new administration.
Thanks for joining us today. If you want to catch up on previous episodes, be sure to check out our PwC YouTube page. Plus, you can follow us on the Twitter handle below. We'll see you next time on 7-Day Yield.